Have you ever bought a house and had no idea what you paid for at the closing table? I mean, you get to the closing table, you're signing all these documents. You might as well even be signing your life away and have absolutely no idea. But sometimes you were probably already told and you were aware of what you were paying for. You just don't know what you were signing. So what I'm going to be going over today is the loan estimate sheet. And this is essential because before you decide on a lender will give you a loan estimate sheet once you've decided on a house. And this loan estimate sheet shows you how much you will owe at the closing table and what the estimated cost of your monthly mortgage payments are going to be. And so before you sign off on any loan with a lender, you need to compare the lenders. You need to compare the offers and the terms they're giving you. Okay, so that's what we're going to be going over today, line by line, step by step, every single thing that you need to know about a loan estimate sheet. Let's get into it. Hey y'all, it's your favorite real estate agent, Dr. Yeti, and I am back with yet another banger, another video. Okay, this video was inspired by a client of mine who reached out to me from Maryland and wanted to get information about this loan she's about to take on from this new construction builder. And so I was like, let's see it. Let's look at the paperwork. She is working with a realtor, but that's neither here nor there, right? But I, in Atlanta, have a very good insight on what a loan estimate sheet should look like so that you can know how to shop for lenders. And so we went over her loan estimate sheet. We went over the numbers, and these lenders, these new construction lenders, are very interesting to say the least. I don't want to say anything negative about them, but the numbers that I saw were just out of this world. And I said to myself, when I purchased my property, no one told me anything. I literally was so overwhelmed with all the documents that I had to sign that I was like, yeah, I'm just gonna sign the document. I wanted to start reading it. I wanted to start looking through it, but I was so overwhelmed with all the information that was given to me that I just went ahead and just signed the documents regardless. I didn't even care to shop for lenders because I didn't know how to, nor did I even know that I could shop for lenders. Okay, and so I was just signing off on documents. And so this young lady coming to me telling me that she was overwhelmed with the process of buying a home and not even understanding what she was signing, I realized that it wasn't just me that went through what I went through. And it wasn't just her that went through what she went through. There are so many others who are purchasing a home right now and have no idea what they're signing off on and have no idea that they can shop for lenders. And so let's get right into it. Hey, I know you are really enjoying this video, but I have some really exciting news for you all. Home ownership should not be a scary thing, but I do understand that it is probably going to be the most expensive investment that you have ever made or may even ever make in your entire life. So it should not be a challenging or questionable thing for you to do. I have started my real estate consulting services geared specifically for first-time home buyers, so you can get every single information that you need in order to be a confident home buyer and to feel confident signing documents at the closing table, knowing what you're getting yourself into, knowing how to shop wisely and how to spend wisely on potentially the largest investment you will ever make in your life. So if you are interested in learning all about how to schedule a one-on-one consultation with me, look no further. The link is in the description. Let's get back to the video. So let's go over this sample loan estimate sheet. Okay, so this sample loan estimate sheet was issued in 2013. So we're not going to see these 2013 rates. Now let's go to the right side. the right side of this first page of the loan estimate form, you want to make sure that the loan term is accurate, right? Typically, you have a loan term of 15 or 30 years. Typically, it's a 30-year loan that you're getting, but sometimes it can be 15, right? So you want to make sure that the loan term is accurate. The purpose has to be accurate as well. It's a purchase, right? Sometimes it could say construction. It can have other purposes for this loan. So you want to make sure that the loan says purchase, right? The product, you want to make sure it says fixed rate if you're getting a fixed rate loan, or adjustable rate if you're getting an adjustable rate loan. So make sure that the product is accurate there as well. Now the loan type, we've kind of, I was going to say we've kind of talked about it. I haven't talked about it on YouTube yet, but I have talked about it on TikTok a few times about the difference between a conventional, a VA, and an FHA loan. There is also USDA loan, jumbo loans. There are different types of loans, and you want to make sure that you have a conversation with your lender. If you qualify for all the loans, but you want to use a VA loan, or if you want to use an FHA loan, but the loan says conventional, then have a conversation with the lender and say, hey, I don't want a conventional loan. I want a VA or an FHA loan. This is where you make those changes, okay? Loan ID, of course, this is the identifying number for the lender to recognize what the loan is. And then you have a rate lock. A rate lock is important because if you don't have a rate lock, you are not going to be locked in on a specific rate, meaning that if you understand the idea that the interest rates of mortgages goes up or down every single day, it changes, it fluctuates every single day. And if you don't lock in the rate at where it is right now, in the moment that you decide to close on that house and the interest rate goes up significantly, you will not be able to get this current rate. So if the interest rate right now is 3.875, which is what it says on the sheet, by closing, if interest rate is 4%, you're going to be stuck with that 4% interest rate. Okay. So if you don't lock that interest rate in of 3.875, you will be stuck with the interest rate at the time of closing. Now, another thing you need to be aware of is there is something called a floating rate lock that lenders can do. And so basically what that does is it whenever the interest rates go up, your interest rates aren't affected, right? But let's say the interest rates go down, you get a rate lock at that lower interest rate. So every time the rates goes down, you get a rate lock, so that you can get the best interest rate from now all the way to closing. Now, rate locks are not free. Somebody has to pay for it, right? In the beginning, the lender will pay for the rate lock, but eventually at closing, they're probably going to add it to the fees that you will have to pay for the origination fee for this loan. So just keep that in mind, that the rate lock is not free. In order for you to lock in the rate, you have to pay for it. Okay. Now moving down to seeing the loan terms. The loan terms is what is the bread and butter of the loan, right? What you're looking at. The loan is how much you owe, what your interest rate is, and how much you need to pay every single month, right? And so your loan, technically, your loan only consists of your principal and your interest, right? Your principal and your interest is what your loan consists of. And so if your principal, which is your loan amount, is $162,000, your interest rate is 3.875, your monthly principal and interest will be $761.78. But this only includes your principal and your interest. Remember, your monthly mortgage payments consists of your principal, your interest, your taxes, and your insurance. So what your lender is telling you here, that the loan on its own, without the taxes, without the insurance, without the external forces, you only owe them every single month $761.78. And this number never changes. For the entire duration of the loan, you're paying $761.71 every single month for principal and interest. Now, another thing you need to pay attention to is this thing called a prepayment penalty. What's a prepayment penalty? So basically what that means is that if you decide that you wanted to purchase this home and pay off your loan within 1 year, you bought this house, you got a loan for $162,000, and now you want to pay off this entire $162,000 because you came across some money. You won the lottery, you got an inheritance, and now you have the money to pay off your house. This prepayment penalty is saying here that yes, they do have a prepayment penalty as high as $3,240 if you pay off the loan during the first 2 years. Now, a lot of loans don't have prepayment penalties. This is only 2 years, so if you don't think you're going to pay off your mortgage in 2 years, it doesn't really matter. But if you do think you're going to pay off your mortgage within 2 years, a prepayment penalty is something that you need to be aware of. You don't want a prepayment penalty. Let them know that. Balloon payment. This is typical for construction loans, but in this case, this is a purchase loan, so this doesn't have a balloon payment. That doesn't necessarily mean that you won't find it in a purchase loan. I'm just saying that typically you won't find a balloon payment on a purchase loan. And what is a balloon payment? A balloon payment essentially is when you take a loan on a property. For example, if you're doing a new construction property and you take a loan on that property, after a certain amount of time, after a year of you taking that money from them, you have to pay them back the entire loan after a year. So it could be after 2 years, it could be after 5 years, whatever the balloon payment is, you have to pay them. Let's say the balloon payment is after 7 years. After 7 years of you paying every single month on this loan, you owe the entire balance at one time. In one go, you have to pay off, let's say you've paid off $62,000 over the span of 7 years on this loan. Now, at the end of 7 years, you owe them $100,000 for the rest of the balance of the loan. Okay. Now, this says no, you don't want a balloon payment. You want to make sure that your loan does not have a balloon payment on it. It has to say no. Like ideally, it should say no, right? Now, here are your projected payments, right? Your principal and your interest. We already talked about that. And then it's saying within the first to 7 years, the first 1 to 7 years, I'm sorry. The first 1 to 7 years, your principal and your interest are going to be $761.78. That is what you're going to be paying every month on your principal and interest. That is going to be all the way to 30 years. From 8 years to 30 years, you're going to remain paying that $761.78. Now, the mortgage insurance is saying that you'll be paying mortgage insurance $82 a month for the first 7 years. However, from years 8 to 30, you don't have to pay that, right? For mortgage insurance. Now, keep in mind that if you have FHA, if you have mortgage insurance, you're going to be paying that for you're going to be paying that for 11 years at least before it drops off. So keep that in mind for FHA. This is a conventional loan. So this is saying that for the first 7 years, you have to pay only $82 a month on your mortgage insurance. Estimated escrow. So your escrow includes your taxes and your insurance, right? And it's basically a mini bank account for your loan, right? And so you need to pay into your escrow every single month to make sure that you have enough money to pay off your taxes and your insurance. In this case, they're saying that you're going to be paying $206 a month for the first 7 years, and all the way to the 30 years, you're going to be paying $206 a month. However, you need to keep in mind that the amount can increase over time. Why? Because your escrow payment accounts for your taxes and your insurance. Your taxes and your insurance typically goes up as the value of your property goes up and over time, right? And so you can always shop around for insurance companies, and you can always contest your taxes, file for homestead exemption. However, your escrow is most likely not going to stay the same for the entire 30 years. But ideally, it's supposed to before you close. So that's why they're keeping it at $206 a month for the next 30 years. Okay. So now it's telling you for the first 7 years, you're going to be paying a total of $1,050 every single month on this property. And then after that, you're going to be paying an estimated amount of $968 a month for the next, for the rest of the loan term. So that, like I said, this number is not always going to stay the same. It's going to change, especially a loan estimate does not account for the cost of your insurance if you haven't even shopped for insurance policies yet. You haven't shopped for insurance yet, and you don't really know what your taxes are going to be the year after you've closed on your property. So you need to keep that in mind. Next thing you need to look at is your estimated taxes, insurance, and assessment. So this is essential for you to know, and it's the same number right here, which is the same amount that's going to be in your escrow that you have to pay every single month into your escrow. And it says this includes your property taxes and your homeowner's insurance, right? Is it in an escrow? Yes. So that's why this number right here, your estimated, excuse me, your estimated taxes, insurance, and assessment is $206 because it's the same as your escrow payment. It's the same thing, right? Because that is the amount that you are paying into your escrow amount every single month. Now, what is your cost at closing, right? Your cost at closing is saying that your cost is $8,054, and it includes your loan cost of $5,672 and $2,382 in other costs, $0 in lender credit. And it's going to explain it in the next page right here, okay? Your estimated cash to close, which is the amount of money that you need to bring with you at the closing table, is $16,054. And this includes your closing costs and your down payment, okay? Now let's go down to the second page, which is a very crucial page for you, right? You have your loan costs, which is your origination fees, the services you can shop for and the services you cannot shop for, right? And then you have other costs. The loan cost is specific to the lender. This is information that is specific to this particular lender. Now, the loan costs are your origination fees or your origination charges, which is what your lender charges you for their services, right? So they charge you $300 for the application. They charge you $1,097 for underwriting. They charge you $405 for the loan amount, right, in points. So this is specific to this lender. You're paying $405 for 0.25% of loan amount, right, in points. And then your services that you cannot shop for with this particular lender is your appraisal fee, your credit report fee, your flood. Like in this case, now I want to keep in mind that your information is not going to stay the same. Like this information on this loan estimate sheet is not going to look like your loan estimate sheet, but it's going to look the same, right? So the services that you cannot shop for are your appraisal fee. And these are fees that your lender is telling you that we are going to take this money from you, but you cannot shop for them. Now, the services that you can shop for are your title insurance, your lender's title policy, like anything title related. 9 times out of 10, you can find your own title company to put on here. Like if your Uncle Ben can give you title fees for free because they are a title company, then Uncle Ben can say $0 for the title on here. There's a survey fee that you can shop for. You can find your own surveyor, and then you can pest inspection fee. That's another thing that you can shop for, right? But this lender requires you to do these things. Like these are things on this left side, the loan costs. These are things that the lender is requiring you to do, but you can shop for some of them and you cannot shop for some of them, right? On the right side is specific to the property that you're buying, right? So these are the other costs that you have to worry about. So now there's something called a recording fee, where when you buy a house, it needs to be recorded in the county, state, whatever. there's a fee associated with that, right? There's transfer fees, right? There are transfer fees that you need to pay attention to. Now, one of the reasons why I felt the need to even come on here and make a video is because the consulting client of mine that needed my assistance, the transfer fees that they charged her was excessive, at least $4,000 over what she was supposed to be paying for transfer fees. She wouldn't have known that she didn't come to me, right? Then there's the prepaids that you have to worry about, right? The homeowner's insurance that you have to pay 6 months in advance for. You have your mortgage insurance, you have your prepaid interest that you're paying 15 days in advance for, right? So these are things that their prepaids is a prepaid section that you also will have to pay for. Now there is an initial escrow payment at closing. So before you close on the house, you need to replenish your escrow account. And so they are going to charge you to make sure that you have enough money in your escrow account for when taxes come out and your insurance payments need to be made. So these are going to be in your escrow before you close. You're going to have money sitting in your escrow account before you close. Then there are other fees that they include. In this case, they have title, policy. It's not necessary. It definitely says optional, but that's a fee associated with it. And so now what happens now is that all of the fees on the right side is added up. And now you own, on the right side for the cost of the home, you owe $2,382. And I forgot to tell you about the left side based on the lender's fees, right? The left side. So one of the things that you should compare is the lender's fees is $5,672, right? So when you're comparing lenders, also compare the left side and see how much it's going to cost you. And that is also if you don't like shop for these other services. Now, on J, where it says total closing costs, it's going to add up the total of D, which is right here on the left side, and I, which is right here on the right side, and you get a total of $8,054. That's where that $8,054 came from. Those are your closing costs, right? That is not your down payment. That's your closing cost. Now, the bottom tells you calculating cash to close. This is the amount that you need to pay, you need to have in your bank account in order for you to close on this property. And we already talked about the $8,054 for the total closing costs. Then you have $18,000 for your down payment that you are paying for your down payment. Then you have a deposit of $10,000. Typically the deposit may be coming from the sellers paying closing costs to you, like the sellers are paying you a closing cost. So then you get a $10,000 fee added onto that. So instead of you to be paying $26,000 at closing, you're only paying $16,054 because your seller or wherever this money came from covered your estimated cash to close. Now, the last page, which is another very crucial page to pay attention to, is the comparisons. Is the third page. You're looking at comparisons. The comparisons is what you use these to measure, or you use these measures to compare this loan with other loans. Now, I did mention this page, but also remember that you can also include part D of the loan estimate form to determine whether or not, you want to go with one lender over another, right? So another thing is in 5 years, you would have paid $56,000 in principal, interest, mortgage insurance, and loan costs. Out of that $56,000, $15,000 went into the actual cost of the loan, which is the which is the principal, right? Your principal is the actual cost of the loan that you're paying into every single month. And out of that $56,000, you have paid off $15,773 in the next 5 years. Keep that in mind. Now, when you're comparing other loans, you will have to look at them and say, okay, this loan says in the next 5 years, I would have paid off $15,000. The other loan says I would have paid off $10,000. However, I've only spent $36,000 in the last 5 years. So that might be a better loan for me. You know what I mean? Like it might make sense for you. It might make sense for you to get a loan that has maybe, you're paying less here, but you're also paying less here. It's up to you to decide what you want to do, right? But you can compare and say, in the next 5 years, how much would I have paid off of my loan versus how much I already spent into this loan? Another thing to keep in mind is your APR. Your APR is your cost over the loan term expressed as a rate. This is not your interest rate. So basically, this is how much you're paying, right, on top of your principal. Like, this is the amount of money, the cost over the loan term as a rate. So keep in mind, when people shop around for loans, they look at interest rates. They said, oh, okay, this lender is giving me an interest rate of 3.875, and their APR is 4.274. Your APR is literally exactly what you're going to be paying for, because it includes all the other fees and all that other stuff, including your interest rate. This is what you will technically be shopping around for. Don't shop around for interest rates. It sounds good to shop around for interest rates, but a lender with another lender that has the same interest rate could have a higher APR. Your APR is actually what you're truly paying for, right? That's what you're truly paying for. Your interest rate is what you owe the lender, right? The amount of money, like the percentage that you owe the lender is directly tied to the lender, but your APR is what you are actually paying, right? Which includes your fees, which includes your interest. It also includes your interest. It includes everything that you have to pay on top of your principal payments. That is what your APR is. And you have to keep that in mind when you're comparing lenders. Don't compare the interest rates, compare the APR. This is important. Then you have your total interest percentage, which is the total amount of interest that you will pay over time or over the loan term as a percentage of your loan amount. So basically what this means is, after the 30 years is done, you would have paid 69.45% of your total loan to the bank or to the lender. So if you got a $100,000 property, you would have paid $69,000 to the bank. So your total loan being $100,000, over the 30-year duration of that loan, you would have paid $169,000, because you're paying the interest and you're paying the principal of the loan. Remember, a lender is not just going to give you money. They're gonna want to make money back from that loan. So in order for them to make money, you are paying the interest. Your interest over the 30 years is 69.45%. When you're comparing lenders, you're comparing these three things: how much you would have spent over 5 years, how much you would have spent only on your principal, right, to pay off that loan, right? Your APR and your TIP. These are very essential when you're comparing lenders. Another thing to pay attention to is there's other things like appraisals. Their appraisal fee may be different from the other appraisal fee from another lender. So keep that in mind, because remember, appraisal is something that you cannot shop for. It's something you cannot shop for. So maybe that's another thing you can compare. You can compare if it's an assumable loan. If the loan is assumable, it means that if you decide to sell the house and somebody liked your current interest rate at 3%, but they live in 2025 where interest rates are 6.5%, they want to buy the house with your interest rate, you can give them your loan with your interest rates. they can assume your loan, and I'm gonna make a whole separate video on assuming a loan, or how to make more, or how to buy a house with a lower interest rate. I kind of made a video about it, about assuming loans, but it wasn't in depth. So maybe I'll make a whole video talking about assuming a loan. But in this case, you will not be able to assume this loan. This loan is not assumable. So if you decide that you wanted to sell this house with your very nice 3.8% interest rate, somebody with a 6.5 interest rate is not going to be able to purchase this home as an assumable loan, because it's not an assumable loan. Another thing you need to keep in mind is homeowners insurance. It says this loan requires homeowners insurance. Most loans require homeowners insurance. So even though it's a consideration, 9 times out of 10, you're not going to find a lender that's going to say, yeah, you can buy this house without homeowners insurance. It's not plausible. Then you have a late payment fee, right? They charge late payment 5% after 15 days of being late. Keep that in mind. They will charge you 5% after 3 days of being late, or 15 days of being late. Some lenders will charge you 3% after being late by 30 days. Compare these things. Now, late payment, I don't think it's enough for me to say I don't like this lender versus this other lender, unless you don't really have everything else matches up except for this one thing. You want to pick something. Maybe a late payment is something to consider, but it's not that big of a deal. Refinancing this loan would depend on your future financial situation, the property value, and market conditions. You may not be able to refinance this loan. Keep that in mind, but this is not just for this loan. This is for any loan. So it's saying you may not be able to refinance it, but it really depends on your financial situation. If you have a completely different financial situation on the downside, you may not qualify to refinance your loan. Keep that in mind. Then servicing, they're saying that this loan is saying that they will transfer servicing of your loan. 9 times out of 10, you get a loan, they will transfer servicers because it goes to the secondary mortgage market, and a bigger lender will buy it as a bulk with other loans, and you will have another lender servicing your loan, typically after 6 months. Because I think legally it has to be after 6 months. They will let you know that we are selling your loan to another lender. So that's typically what happens. And then once you go through this, you confirm receipt of this loan, you sign your name on the dotted line, and boom, bam, pow. But here's the thing, right? If you sign this, okay, and then act surprised, you cannot act surprised because they gave you this information. I really hope this video helped you with how to look at a loan estimate sheet, how to potentially shop for lenders, and really what you're signing for, right? You may be signing your life away and you have no idea. So I really hope this video helped you. If it did, make sure you like the video. If you know someone that needs help on these types of things, send them this video. Okay, and make sure you subscribe to see more of me, and let me know in the comments. I want to know what other types of videos you want me to talk about. If there's any specific contract or documentation you want me to go over with you guys, I would absolutely love to do this. And if you are in the Atlanta metro area and you are ready to buy your first home, reach out to me. My contact information is in the description of this video. Okay, thank you so much for watching. I love you, and remember, God loves you even more. Bye.